Good day and welcome to this episode of PhillipCapital's Market Watch. My name is Teo Huan Zi, Dealing Manager at Phillip Securities. Today, we'll be taking a closer look at Singapore's resilient stock market and what its recent outperformance means for investors and the broader economy. Singapore's stock market is defying global headwinds with the Straits Times Index STI surging 14% year to date, reaching multiple all-time high in 2025. At the same time, the Singapore dollar has strengthened sharply against US dollar and other major trading partner currencies. But what does this mean for Singapore's export-driven economy? In this episode, we'll break down the STI rally, the Monetary Authority of Singapore MAS exchange rate policy, and the implications for importers, exporters, and inflation. Singapore is increasingly being viewed by global investors as a safe harbor amid ongoing US-China tensions. The stability and resilience of local stock market continue to attract both foreign and domestic inflows, with particular interest in Singapore banks and REITs. On the monetary front, the MAS maintained the SNIA, or the Singapore dollar nominal effective exchange rate policy band in 2024. In both January and April 2025, MAS adjusted the slope of appreciation while keeping the width and center unchanged. This allowed for a modest and gradual strengthening of the currency, a strategy that supports price stability without overly dampening export competitiveness. In equity performance, technology-related counters, retail, and the property sector have all posted strong gains in 2025 year-to-date. Coupled with the robust performance of Singapore banks, the STI have recorded multiple all-time highs throughout July. Beyond the STI's strong performance, the Singapore dollar SGD has also strengthened significantly against other major trading partners, including the US dollar, USD, and Japanese yen, JPY. While USD has weakened over 9% year-to-date, the SGD has strengthened by 6% against it, with several notable effects on Singapore's economy. A stronger SGD enhances cost efficiency for sectors such as F&B, electronics, and energy. Cheaper imports help lower the cost of raw materials, food supply, and energy, benefiting firms that rely heavily on stable or reduced import prices. On the other hand, manufacturers and logistics companies are facing margin pressures. A stronger SGD makes Singapore exports more expensive, which poses a challenge for industries operating in highly competitive markets, especially in sectors like electronics, where Singapore faces strong competition from Taiwan and South Korea. On the macroeconomic front, headline inflation dipped slightly to 0.8% in June 2025, while core inflation remains steady at 0.6%. These moderated inflation figures may provide the Monetary Authority of Singapore MAS with room to ease monetary policies, offering some support to growth amid increasingly uncertain global trade environment. Given the market volatility, Singapore-based investors are fortunate to have access to a variety of relatively safe investment options. STI blue chips, particularly local banks such as DBS and UOB, and REITs including CapitaLand Ascendas, remain attractive. High interest rates continue to support bank earnings, while any rate cut ahead could benefit REITs through lower borrowing costs. Singapore bonds also present opportunities for conservative investors, offering yield stability and potential capital gains as rates ease. For those seeking for sector exposure, retail and logistics names such as DFI Retail and Mapletree Logistics Trust stand to benefit from cheaper import prices and resilient domestic demand. Meanwhile, MAS-led efforts to boost market activity are supporting liquidity and interest in small and mid-cap stocks, many of which remain undervalued. Despite a bullish sentiment, investors should remain cautious of emerging risks. The STI is currently trading at 15 times PE, above its 10 years average of 13.72, raising the risk of profit-taking if negative news surfaces, locally or globally. The SGD remains strong even after MAS eased the slope of its exchange rate policy in January and April. Should this trend continue, MAS may be prompted to act more decisively, making its upcoming July policy review a key market focus. Globally, a potential US slowdown, whether from renewed trade tensions or concerns over US President Donald Trump's health, could weigh on external pressure and offset gains from a stronger Singapore dollar. Singapore's market rally resilience is based on strong economic foundations. However, MAS continue to walk a fine line balancing inflation control with export competitiveness. For investors, the focus should remain on quality STI stocks, SGD-denominated assets, and sectors supported by a stronger currency. In a trade-dependent economy, adaptability is key. That's all for this episode of PhillipCapital's Market Watch. If you found this video helpful, do like, subscribe, and stay tuned for more insights. Thank you for watching, and see you again next time.